now we have a high conviction strategy. My next guest, Andrew Coleman from the Tip Group, believes in a Charlie Munger saying, which is, when in doubt, invert. That will become clear what he means by that in just a moment. But I began this conversation by asking what investment strategies Tip Group actually compares itself to.
Look, I think the market falls into, or all participants in the market fall into three categories. Either short-term or day trading. That's people trying to take a bet on how the market will perceive a piece of news. Momentum trading, which is sort of looking maybe a few months ahead, trying to work out how a trend will play out. And then long-term investing, which is taking a bet on the underlying asset, whether that's a company, a commodity, or an index. And so I think when you look at the market, it's important to break everyone down into their categories of what are they actually acting on? Are they acting on a need to take advantage of a reaction to a piece of news? Or are they looking at what's actually happening underneath the surface? And of course, it's much harder to look at what's happening underneath the surface than it is to get caught up in the noise day to day.
So by that, I believe you're implying that you are a long-term investor. You fall into the latter category.
Absolutely. And the problem, of course, for those who aren't, and I'm sure there are people out there who do make money as day traders or momentum traders, is just that the research doesn't back up what they're doing. It's guesswork. From a day trading perspective, research shows that less than 1 in 200 day traders ever earn the same wage as they would if they were working as a bank teller. And for momentum traders, you have to pick a momentum, according to economic research, within about the first month and a half of a trend occurring in order to make an outsized return of as little as 0.1 to 0.3%. I don't know about you, but that's kind of hard to get out of bed for.
Yeah, well, anything less than $10,000. I'm kidding. But you've got the data to back this out, because I do know that Tip Group, you sort of pride yourself on being very research driven.
Absolutely. I mean, look, the reality is that anything in investing should start, I believe, but I'm a nerd by background, with fundamental economic research. And over the last 24 years, we've been testing our philosophy again and again in the market. And taking just an automated portfolio, so ignoring all of the great stock picks that people might make, and just following our simple rules, we've delivered an over 800 basis points alpha for 24 years, which is roughly the difference between $1 million being worth $42 million 24 years later, or 7 if you'd put it in the index.
Okay, long-term time frame, that's been established. What is this time frame? Because long-term can mean different things to different people.
Absolutely. I think long-term is a bit of an amorphous concept. I think the important thing to think about is that in order for you to make investments as opposed to bets on the performance of an underlying asset, no matter what that asset is, you have to give enough time for that asset to not only perform, but for other people to realize that performance. And there's that classic problem, which is that you can be ahead of the curve in anything in the world, technology, investing, science. But if the world hasn't woken up to it, they won't value it. And so long-term investing to me really means 5+ years, but it can mean different things to different people. The key is that you're invested for long enough to see not only the underlying asset move and the market wake up to it.
Okay, so can you just reiterate what you'd said about the research that you've done over the past 24 years and what you've found through this style of investing?
Yeah, absolutely. I think from our perspective, we have 24 years of research of trying to work out not how to pick winners, which is very difficult. There's a lovely term, of course, in investing these days about a unicorn, which of course was originally a pejorative term. We called them unicorns because they were mythical creatures. It's pretty hard to find them. And the biggest problem with unicorns, of course, is that the longer you look and the more light you shine on them, the more often they start to look like dogs with an ice cream cone on their head than a mythical fairy tale creature. The joy, of course, is when you look at underlying assets is you don't have to try and pick unicorns. You can look to try and avoid the dogs masquerading as a unicorn. And it turns out if you do that, you just try and exclude the bottom tail of the distribution, then basic maths tells you that the average of that subset, excluding the worst performers, will be better than the subset or the total set, including the worst performers as well. And so when you can do that, and there are some simple rules you can do that, which includes things like knocking out the obvious dogs, the ones that have never made a profit, that have appalling return on equity, that are loaded up with debt, that have management who have acted unethically or dishonestly, then the subset that you're left with tends to outperform the ASX long-term average, which is about 8.5% as we know, by about 8% per annum. So you're talking 16 to 18% per annum returns in that subset. And that's what we've been able to achieve throughout our time period just by following that simple process.
Okay, so your conviction is in this process, identifying the dogs versus trying to seek out the mythical unicorn.
Absolutely.
So is that what brings about outperformance? Because I will say, even for many long-term funds, they slightly outperform the market if they outperform, the index at all.
Yeah, look, 23% of active managers manage to beat the index on average, which is pretty appalling when you think that statistically half of them should beat the average, if they're part of the average themselves. But I think the problem that they all get caught up in is exactly as you just pointed, trying to pick unicorns. And not only are unicorns very rare and very mythical, they're hard to identify. What is going to make a company worth billions of dollars on nothing more than a story or an idea? Well, if we all knew that, we'd all be rich. But it is actually quite easy to tell dogs. And I think the problem with that is it's boring. It's more exciting to be picking unicorns, but then I also think it's really exciting to lose your house. I'd probably prefer to be boring.
In a wrong way. Yeah, and that's what I was going to say. So this unicorns versus dogs, so identifying the dogs, it requires work.
Absolutely. I mean, I don't think anything in life is easy if you're, just sitting around on your hands. In fact, anyone who does sit around on their hands and expects to get a return probably would be better off investing in Lotto next week. I believe it's at about 100 million and the odds are probably slightly better.
So how then, just reiterate, those easy red flags that you can use to identify a dog?
Absolutely. The first question is, has the business got a history of making profits? As the lovely old saying goes, revenue is vanity, profit is sanity, and cash flow is reality. The second question is, how well do they use shareholders' funds? Are they regularly going back to mine shareholders' wallets for more money on the promise of a return that hasn't come yet? Or have they delivered to shareholders what they said they would? The third one is, how have they achieved that return? Have they done that through investing their equity and hard work, or have they done that through spruiking and raising lots of debt? Because of course, the great problem with debt, as Benjamin Graham said, is it's like an umbrella the bank takes away as soon as it starts to rain. And then lastly, and most importantly, and probably the hardest to do, because you certainly can't do it just looking at a P&L or balance sheet, is working out, are the management and board acting honestly and as partners with shareholders, or are they in it to feather their own nests, or perhaps do something a little bit less ethical with the money?
And when you are looking at management style, how do you do that? Because for many investors out there, they've got the opportunity to read the market announcements, to maybe read a few headlines or stories that are written in mainstream financial press. So how can you enhance that knowledge of management's alignment?
I think from my own history of dating, and I'm not sure about yours, it's very hard to pick if someone is going to be honest and ethical the first time you meet them. So I think the key is multiple dates, meet management a lot, and check what they've said against what they've done in the past. So for example, have a look at what management said 5 years ago or 4 years ago about what they expected to achieve and how they worded that. And then have a look at how they say today about what they did in the past. Because usually the good news is that telling a lie repeatedly is hard work. It's easy to lie for a short period of time. It's hard to keep the lie going for a long period. So if you can look at them over a large enough period, and it's one of the reasons why we as an investor won't look at anything that hasn't been listed for at least 4 or 5 years, it gives you the opportunity to test what they said in the past with what they say today. And just like dating, give you a little bit of a better idea of, is this someone you may want to be in bed with?
All right. So just before we go any further, because we will get some of your ideas for winners and potentially losers in the next 5 years. So I'm putting those markers around the next conversation. But what type of returns are we actually talking about here? What type of returns have you achieved in the past using this process?
Look, very easy to get 15 to 20% long-term before costs. And we've just demonstrated that for 13 years in our equities fund, for 24 years with our research, and for 13 years in private equity. The difficulty is when you want to start pushing those numbers higher, because the risk you're going to take requires you to start picking winners, not just avoiding losers. And that's a very, very difficult strategy. So what we do is try not to lose our sleep at night, not worry about getting anemic returns, but also not try and get north of 20% per annum, because if you do, it's probably not worth the effort.
Okay, so you use the term pick winners, and I know that we are using the process of identifying dogs to get these winners, but please, what companies, what ASX listed companies do you reckon will outperform in the next 5 years?
Well, let's look at the ASX 100 because it's probably the most valuable for most people at ausbiz. I think really the market is giving you some fascinating opportunities right now in some of the most boring, stable, but most importantly, highly demanded products and services that are out there. Companies like ResMed, which has a long history, of course, of changing the world and is trading right now at historically pretty low PEs. Companies like James Hardie, ignoring the scandal, of course, many years ago, but has since come back and is now today one of the largest building materials companies in the world and trading on a PE roughly half of the market average. There are others, and we can go into them, but I think what would be more fun is maybe talking about some of the potential dogs out there, because I think right now is one of those points in history where there's a lot of unicorns that are really dogs with cones strapped to their heads.
All right, so let's get into it then, because are we talking about those really high PE companies?
Some of them
Okay.
but I think what's more interesting, again, if we look at the ASX 100 and maybe some of the market darlings, and what I'm about to say may make me very unpopular with my peers, but I think that there are 4 or 5 in the ASX 100 at least at the moment that with a little bit more light may not look quite as good.
Okay.
And if you take some market darlings that are quite interesting, take Xero as an example. So Xero currently has a market cap of $27 billion. That's a very, very large company. In fact, it's 20% larger than James Hardie. It means that today it's trading at roughly 20 times revenue. That's double what Cisco reached in the 2001 tech bubble. It's also, in the last 10 years that it's been listed, lost a cumulative $450 million of shareholders' money, which means, and it's currently trading on a P of over 130. Now, I'm not going to try and make a prediction what's going to happen tomorrow or the day after, but I'd be worried about an accounting software business that apparently is worth lots of money and yet can't even keep itself in the black.
Okay, so that would be controversial because it's, as you said, a market darling,
Absolutely.
an Australia, New Zealand success story. So if you owned Xero, would you be selling Xero?
Well, I probably wouldn't own Xero, and maybe I've missed out on some great returns, but I think the problem with owning Xero right now is the odds are probably more likely that it's going to end up at a valuation closer to its name than double from here.
That is a big call. Just to put a finer point on it, you're not upset that you've missed out on some of the returns that long-time Xero shareholders have achieved up until now?
No, absolutely not, because I think any long-time Xero shareholder who's got those returns either had an incredible crystal ball or they got lucky. And in the same way as I wouldn't begrudge a lotto winner their winnings, I wouldn't begrudge a Xero investor theirs.
Okay, I'm going to throw a name out there because we have had viewer questions coming in about this company. Life360.
I think Life360, I'm a parent of 2 children, I think Life360 is a fascinating product. It's a great way of keeping tabs and probably pushing every boundary of what's really acceptable for privacy. But I think when you look at a company that again has lost close to $500 million of shareholders' money in the 5 years since it's been listed and is trading at a market cap of $5 billion, probably the best reason that it continues to do well is that it's worked out an incredible capital raising formula, which is to keep tabs on all its shareholders' wallets at all times.
Now, if the PE came down for Life360, if you believe that it's a fascinating product, if you have confidence they can roll out the advertising model, is there a price that you would pay for the likes of Xero and Life360?
Absolutely. I think the first thing, though, in the case of Life360 is they'd have to make a profit. You can't have a PE without any E. But in the case of Xero or the others, I think the market average long-term multiple has got to be the place you start. And historically, the market average has been between 15 and 20 times earnings. And a business at the moment that's trading between 15 to 20 times earnings with a long, steady track record of making money for its shareholders is a bargain. It's always going to be a bargain. Companies with a PE of triple digits that have, at best, a checkered history of delivering profits sounds like more of a gamble than perhaps an investment. And just as I have friends who, when we were at university, would go down to the casino and bet everything on black and sometimes come away with money, I think investing in them today is probably even worse odds.
Well, your friends are more fun than mine, I think. Now, I'm enjoying this. So any other companies that you're willing to name as a dog right now?
Well, I think they're potential dogs,
Okay.
Let's be honest. I mean, I don't know the future. They could get it right. And the beautiful thing about being in business is that management can take anything and turn it around, hopefully positively, sometimes negatively. But I think 2 others that stand out to me from the ASX 100 as potentially more risky to be invested in than not would be Woolworths. Which
Really?
Is,
but
absolutely.
that's blue chip.
Well, it's a consumer staple business that has had more customers every year for the last 10 years than the year before, has had massive inflation in the price of what it can charge, and yet still has failed to grow profit at the basic CPI. Now, if that's not an indictment of management's ability to run their organisation efficiently, I'm not sure what is. Perhaps the interviews. were a bit of a giveaway.
Okay, well, there we go. We'll leave that one. Okay, so...
And then the other one, if I could throw another in there, would be Seek. I think Seek is a business that's had a great position in the market for many years, but is now being challenged from all sides inside the job market. And whilst I think Seek has been a great historically Australian success story, I think the best thing for the management and board of Seek right now is that they currently operate a job board, so they can know where to look.
Oh boy. Okay. So if again, you were looking as an investor at these companies, you would be selling out of a Seek, a Woolworths, because so many people have a Woolworths in their portfolio.
Absolutely. Look, I think they all have the potential to be incredible businesses. And my tongue-in-cheek remarks earlier, I think they all have incredibly talented, successful management who could turn them around. The problem is that turning businesses is very, very hard. It's the reason why 2/3 of companies on the ASX fail to make a profit in any year. If making money was easy, everyone would be able to do it. And I think as an investor, you have a luxury that management doesn't have. Management has to seize that bull by the horns and wrestle it in the direction it needs to go. And good management will. The beautiful thing about being an investor is you can decide to sit on the sidelines, pull your capital out, and put it somewhere else where it will do more for you while you watch to see if management can perform. So if I was in those companies, I'd be looking to pull my capital out and put it into some of those companies that are actually right now clear winners at clearly good prices. Companies like ResMed, as I mentioned before, James Hardie, Data3, we can throw in John's Ling Group as well, and from the ASX 100, obvious staples like BHP and Car Group.
How about CSL?
Look, I think CSL is a great Australian success story, and I think right now it probably looks like much more of a bargain than it should. I don't think the market is properly valuing what's going on inside the company. It's caught up much more in the scandal, or well, not scandal, wrong word, but the poor performance of their recent acquisition. But, you know, this is a company that sells something that everyone needs and we need more of and is growing well faster than inflation. So I think right now CSL is absolutely one that I'd be putting my money into instead of some of those potential unicorns.
What about those companies that have actually made money that are, from what I've been told many times, well run, like a Pro Medicus, like a Technology One, like a WiseTech?
I think those are three companies that are outstandingly run businesses. I think the problem is they are trading at the moment on prices that are not just outside the bounds of normal history, but so far outside the bounds of normal history that the reality is, in the long term, I think there's only one direction they can go, and that's not valuable for buying right now. You know, historically, I mentioned before around Cisco in the tech bubble, but we used to talk about an incredible bubble being when a company reached multiples of revenue, not multiples of profit. And the biggest bubble we'd had previously in Australian and US stock markets in recent memory was, of course, 2001, where companies reached in some cases as much as 10 times revenue. The three you've just mentioned are all trading many, many, many times higher than 10 times revenue. And that means the growth that they would have to deliver is just a level that would be almost a mathematical impossibility to justify their current share price if the market returned to historic norms.
All right, so that is, you know, an insight into Tip Group's high conviction process, and that is dogs versus unicorns, if
Absolutely.
we can sum it up like that. I did just, in the interest of time, want to get to a couple of questions that have come in from our viewers, and this was from Alf. Thanks, Alf. Does this listed company strategy apply to private equity as well? Because we do know that Tip Groups invests in private companies too.
Yeah, absolutely. I mean, what makes a good business is irrelevant whether that share price of that company is being traded daily or trading over the counter in the private market. So all of those same questions: has it made profit? What's its debt like? Are the earnings stable? What are management doing with your money? They are as relevant, if not more so, in the private space as they are in the public space. The big difference, of course, between the private and public space is, number one, it's harder to find them because there's not some nice, easy way to go and search for them. And secondly, if you get it wrong, you're stuck. Unlike in the listed space, where if we make a bad investment, we can quite easily just sell out and get our capital. In the private space, quite often, just when you want to sell out, there are no buyers. So for those playing in private markets, I think all the same rules apply, but you would want to pay a lower price for every dollar of earnings because you have less ability to find them, and it's harder to get out.
Yeah,
and
that's
certainly
that
the process
liquidity issue. Okay, and just to finish off here from Rachel, How many stocks should one have in their portfolio, in your view? Because you've named 5 winners.
That's a great question. Look, economic research shows that if you could keep a perfectly uncorrelated portfolio, you only need 8. The problem, of course, is I don't know anyone who'd be A, comfortable sleeping like that, but B, manage to get a perfectly uncorrelated portfolio. So the advice I tend to usually say is somewhere between about 12 and 18. That enables you to sleep easy at night, but also not get stuck into the business of diversification by holding too many potential dogs.
And diversification, haven't heard that one before. And of course, allows you enough time to do your research or to connect with people like yourself.
Absolutely. I think it's quite easy to get a handle on 15 companies you really like. It would be very hard to do 50, and I feel very sorry for my peers out there as market strategists who have to cover 500 or 600, because I don't think I could know 500 or 600 things well about anything, let alone something as volatile as individual company performance.